Hey, it's Nancy Cross with eXp Realty, and I'm here with Ken Ynes today from NFM Lending. Ken is one of the top loan officers in NFM, and he and I have worked together since, what, 2006, 2007, Ken?
Yeah, when it was tough before.
But it was tough in the other direction, right?
Right, in the other direction.
See, here's my anecdotal story. I remember 2008 to 2010, and I would drive by some of the real estate windows, and there were listing flyers plastered all over the windows. And I think, man, this is a tough market. There's so many properties on the market. These days, you drive by those same windows, and there's hardly any properties available for sale. I go, wow, this is a tough market.
Now you can wave at the receptionist, right? Like before you couldn't see the receptionist. Now you can see the receptionist. So true. So, I just thought of that image, but yeah, you nailed it. You nailed it.
Yeah. So, you know, you and I have been through the up, the down, the back up again. And there's been so much media coverage about the real estate market and mortgage rates. And the media tends to scare people. And I want to take a couple of minutes with you to talk about what's really going on. Where's the housing market now? Especially here in Tampa Bay, because this is what we know. Where are interest rates, and why did the Fed do what they did by raising the interest rates? And I know that you can kind of educate us on that.
Sure. So a couple of things happened. So we're seeing inflation, and that's not any secret to anybody. Let's just simply drive down the street and you can see it at the gas pump. Okay. And I'm a keep it simple, stupid guy. I like to try to keep things where they're visual and they're easy, but that's a direct reflection on a lot of things. Okay. So one of the techniques from the federal government when there's inflation is to raise the cost of money. Okay. Raise the cost of funds to either how we buy money as a mortgage company or short-term money, which is primarily like home equity lines of credit, credit cards, and automobile loans. Okay. So they raise that in an effort to slow some of the economy down a little bit because it's kind of furious. So one of the things that is one of the first of all, it's one of the highest changes at 0.75% in a long time, and then it's, you know, the inflation's kind of close to a 40-year high. Okay, again, I don't want to make light of that, and I'm not trying to say, hey, but this isn't doom and gloom. Let's all take this into perspective. So one of the other things that we can look at is that we tend to start getting short-term memory. And you and I had a conversation prior to coming on screen, and you said there's a whole generation of buyers that never saw 6%.
Yes, that's true.
In mortgage rates.
For the past 12 years, they've been under that. Yeah,
I'm looking at the graph right now, and it's almost longer than 10 years. You know, it's almost since 2010. So it's 12 years, okay, that rates were low. We saw in 2020 a incredible, like 100-year floodplain. We saw a 100-year low in mortgage rates in the twos. Yes. And so I get it. It's so exciting. And that's what everybody kind of gets glued to, and they forget that there's cycles. And as I look at graphs, you know, if we look back to the bubble bursting when Nancy Cross is the queen of short sales, but if we look back to then in 2004 and 5, we were what I called at that time the refinance boom. And so we were doing refinances like crazy. And then all of a sudden the housing market picked up. And that was because the interest rates were so low. And there's some exotic loans out there. And the valuations were going up because people were buying although they were buying with financed money. So it created a different environment than it did now. Okay.
Exactly.
So we get down in the threes, high twos, threes. The bubble bursts in 2000, let's call it 2007 is when I personally have felt it. So I'm going to use that date.
That's when I felt it as well.
So 2007 to about 2010, we're dealing with short sales and high inventory and trying to get properties off we're trying to sell houses, and the rates at that point in time through those years were in the 6, 7s, 8s. For a brief time into the 9s. Not again, sounds crazy, but it was closer to 2001 and 2 where rates were 6 or 7, and so people didn't forget it as easily. Okay.
Right.
So then after 2010, we start seeing this generation of rates that are staying stable. Okay. When I say, and I want to use my hands, staying stable, because we didn't see them go up too much. We didn't see them go down too much. You might have a bad quarter and they go up to 5.25 or down to, a great quarter and they're down to 4.25 and, maybe close to 6 once in a while, but not really. But then it's not too far apart. So you're not all really, it's not too uncomfortable, right?
Exactly. Right.
So now we encounter this magical 2 years of twos.
Yes.
Just twos. And all of a sudden we have short-term memory loss, and everything that happened in the past is forgotten. So we went through a period where we went up, we went down, we leveled off, we went down, where now we're kind of going back up. That is just an economic cycle.
It's a cycle. You're exactly right.
Typically, those cycles are about 7 years. And again, there's no, if we look back at averages, we would see a 7-year cycle.
Right.
Florida,
and we're overdue.
Yeah, we are overdue. Florida has been on an upward trend since about, I would say, 2010. Wouldn't you say the valuations have been going up since about 2010?
2010 we hit rock bottom, and
you were so kind to send me a graph, and that's about right. 2010, almost 2010, 11, it almost hit the bottom, and then kind of has been cycling up. So for about 10 years, we're in a positive growth. Okay.
Right.
Again, a cycle. We're a little long in the tooth on this cycle. Okay. And I would anticipate that this cycle should, with the rates and things like that, I would anticipate that the housing prices will level off. And then I'll let you speak to this. But one of the things that I see from the lending side, because it's so challenging to get contracts through, is that it seems like all the cash buyers have spent their cash. Okay, so they're influencing the market. Like, I don't care if I pay $25,000 over the market price. I just want the house and I got the cash, right?
Yeah.
So, we're seeing where less of those players are in the marketplace, and now it's getting back to the finance clients, right?
Yes.
So that's kind of in a nutshell where it's at. Look, let me just summarize everything that I just said. Even at 7.5%, we're at a 50-year average.
Yep.
7.5% interest rates are on a 30-year fixed are a 50-year average. Holy smokes. That's amazing over the course of 50 years.
You're exactly right.
That's great news. That's not bad. And guess what? If we feel like that's high, then there's going to be a turn in the market in the future. I don't have the crystal ball. Really smart people that I read anticipate that in 2024. Again, don't hear me say that. These are some of the things that I'm reading. Everybody can find it, Yeah. But what are you seeing in the real estate market along those lines?
So let me tell you my personal story. My very first house that I bought in 1985. So this tells you how old I am, right? My very first
Were you
house.
a teenager when you bought that house?
Love you, Ken. Love you. My interest rate at that point was 15.75%.
Wow. Wow.
So yes. And I remember talking to my parents and saying, what's your interest rate on your mortgage? Because as a kid, you never think about that stuff, right? So you don't buy your own house. And my parents said about 8%. And I thought, wow, never going to see that again. And now look at where we are, right?
Yeah.
So when 2010, we got through the crash. You're right. It was about 2007. Phone stopped ringing, and I thought somebody cut off my cell service. Nobody's calling me anymore. And then everything tanked in 2008. We started doing the short sales. And by 2010, you're right, the prices started creeping up again. We were coming out of it and starting to kind of claw our way back. And the housing prices have continued to increase since then. And we get to 2020 with the lockdown. And I'll tell you, my initial thought was, oh, Lord, please don't let it be 2008 again. And I think a lot of people thought that because we had no idea the pandemic was new for all of us. And all of a sudden, people realized I can work from home. I can live anywhere. They're coming to Florida because the weather's great. We have no state income tax. The cost of living is relatively good here. Why wouldn't I live in a place where it's like vacation all the time? And so people started moving here. Combine that with low interest rates, and it was just this unbelievable cycle, and including the issues around supply chain. So the builders were not building fast enough to keep up with the demand. And all of a sudden, we've got this feeding frenzy of homes and buyers lining up to get in for open houses and submitting offers. We were seeing, in some cases, 14, 15, 20 offers on a property.
Yeah.
And so now that kind of activity is just not sustainable. So I think that this is a good thing because, like you said, it's a cycle. It's going to make things a little more affordable or easier for buyers, finance buyers, to actually buy a home without getting outbid by some crazy man. And so I'm seeing inventory still, it's starting to creep up a little bit. We're seeing more homes come on the market. I'm seeing homes that were pending come back on the market, which is telling me that people are not doing that appraisal gap quite as much as they were before. I'm seeing price decreases. I'm even seeing builder inventory with closing cost incentives, which I haven't seen for a very long time. So things are starting to ease, and that's a good thing. So we're typically, have been for the past, I would say, almost a year, like 1 month of inventory, which is very, very low. In a typical market, you're going to have 3 to 6 months of inventory for supply and demand. The number of homes available for sale to the number of buyers.
Right.
And we have been way low on that. So I think an easing of the market is going to be a very good thing for everyone. Homes will stay on the market a little bit longer. We're still going to see price increases because they're projecting population growth over the next 10 years of 14, 16, 18% in the Tampa Bay area. So there's still going to be strong demand. And I think we have a very healthy economy here. So I think all of that is going to continue to keep our market strong, but it will help with buyers being able to have access to properties for sale. So I'm hoping that all of this is coming together at the right time.
Yeah, interesting thing, and I know that both of us did this. I listened to one economist speak to a group of people not too long ago, and you listened to another one. And the positive thing that came out of this for both of us, and it was identical, is that Florida's growth rate is going to continue to go.
Yes.
And much like you said, that people can work remotely or virtually. They're like, well, why wouldn't I work in Florida? No state income taxes. The weather's great. Believe it or not, the cost of living is way lower than everywhere else in the country for the most part. But one of the things that we saw during this, and these economists both said, is that some of the highest rates of employment are in Florida, even though employment numbers are down. It's high in Florida, and some of those are some of the highest rates of executive employment is coming to Florida. Why? Because those executives know that they can work remotely from their homes.
Exactly.
So it's and then for them to fly out of Florida to go to their corporate offices or anything like that, it's not a big deal. And these are a wide variety of executive type of people. It's not just, the president of, or it's not Bezos from Amazon, but it's regular people like you and I.
I'll be happy to help find him a home.
Right. He's paying cash. So anyway, but that was a fascinating part. And Florida's economy is strong because we do have a higher employment rate. And one of the areas that was the weakest was in the entertainment sector, like restaurants and theme parks and some of those other places. And it bounced back. It really did good based on these particular economists and their words. So wise broker once told me there's never a bad time to buy real estate. You can either rent it, you can live in it, or you can sell it, depending on the market. And it's so true. And it doesn't matter really what the interest rates are. And if the interest rates come down, you know what? You're just going to refinance and save yourself a truckload of money, or put it into it. You're going to do a 15-year fixed, or you're going to pay it off quicker, or whatever the circumstances are. But there is just there is no, this is just a life cycle, and it's how we interpret it,
That you're exactly right. You're exactly right. And don't listen to the scare tactics from the media. The sky is not falling.
No. And it's just wonderful that, it's just such a positive thing for you and I, because we get to see the end results of people getting into their dream homes. And it's so satisfying, right? The nice letters I get and you get at the end of the day, it's just so genuine. So, this is really important for people to hear that, today is just as good a day to buy a house as any other time in history.
Yep. I agree with you 100%. So
well,
all right. Thank you so much for your time, Ken. This was exactly, I think, what people need to hear, that it's still a great time to buy. It's still a great time to sell. Things are still moving. The economy is strong, and we're here to help them.
Right on. So look for Nancy Cross or Kenny Ynes with NFM Lending, and you guys have a great day. Thank you for taking time with us.
Thank you. Thank you, Ken.